right, so I'm gonna present parallel finance very quickly with you guys. So parallel finance is a institutional grade lending protocol for Polkadot and Kusama. So our team are basically from Stanford, and we have top tier investors from Pantera, Polychain, etc. So we see the problems in the space are essentially three things. First of all, there is not a really good money market yet for Polkadot and Kusama. And then we see this competition issues between lending and staking, which I will explain in a bit later. And lastly, there are kind of a missing piece for the fixed income, fixed term markets for this ecosystem. However, on the left, you can see there's a huge market demand and large amount of token holders in the space. So how large it is, I just use Ethereum to give interesting examples. On the left is top lending protocols and staking protocols with their TVLs. Notice that the TVL numbers might vary based on the time. For Polkadot on the other side, you can see the current use cases, right? The usage, 50% of the DOT and Kusama will be used for staking. We have a solution for that, which is our xDOT and xKSM staking solution. And then it was estimated that 30% of the DOT and Kusama will be used as parachain auctions, and we have a parachain loan markets for that. And eventually the 20% liquid parts, we have a money market protocol to support as well. So there are some existing solutions. I am only comparing with Ethereum, but we will talk about Polkadot later on. So if you see those projects, you can see different type of method that they use. And then I'm gonna give a pretty quick demo on the product, and then to show you guys how we work at this moment. So if you go to our testnet, here is the overview page that users can go in. First of all, for community, we have to apply for some test token on our testnet. So go to Discord and go to the Faucet testnet channel to apply. First of all, obviously, you have to install your wallets, and you can see that's our network connected to the Polkadot and Kusama network, and see how much native token you have. And then going over to this page, we designed this dashboard page, which is essentially a kind of a Zappify for Polkadot. So you can see the total net worth that you have. That includes your asset and debts minus the debt. And users can be able to easily see the total amount of capital you have under your wallets, deposits applied, loans, and then staking. And then here we sort of divided up the asset into two groups. The first group are the assets that are already inside the parallel. So technically you have to transfer from the outside network, for example, Kusama network or statement to our network to have that. And then other assets in other network. Currently, we support Kusama, and then after the parachain XCM transfer has been a little bit more stable, we will support USDT from statements once they launch, obviously. So obviously, what people can do is they can transfer the whole amount to our protocol. And then going over to the lend and borrow page, this is where users can start to earn the yield on top of their staking operations. For the time being, I'm not going to give you guys the specific introduction to staking, but essentially people stake their Kusama to earn xKSM, which is our staking derivative, and people can supply into our markets. So a simple example here is that if you see here in my wallets, I have 1,000 xKSM. What I can do is I can supply to the markets, and then I can confirm. Now there's a Polkadot.js confirmations. And if it succeeds, then the money will go inside to the supply. You can see the difference. And notice that the interest rate changes well because of the supply issues. The more supply you have, the less supply rate you have, which is market dynamics. And now what people can do is they can open that up as the collateral and then start to borrow some more cash if they want. For example, they can borrow USDT, they can borrow Kusama to restake. There's plenty of options for users to play with. Now notice that the total borrow limits is $400,000, but you notice that here you can only borrow up to 250. The reason is because in our USDT market, it's very small so far. It's a testing environment. There's only 500 in total we supplied. So the total cash that is available is 250-ish. So let's assume that we're just going to borrow 187. And then what users can do is they can start to use the wallet's balance to buy additional Kusama if they want to participate in yield farming and things like that. So that's a really quick introduction to the products. And then we're developing a lot of new product on the staking portions. And then we'll show you guys next time. And so let's go back to the slide. Okay, so one thing I want to mention about is the interest rate curve on parallel. So in a typical money markets, right, we have this piecewise functions that have two slope, and then there will be one kink ratio, which is around 80 to 90%. If you see the blue curve, which is the compound interest rate curve, the x-axis is the utilization ratio and the y-axis is the borrow interest rate. That's how they determine. And for us, we combine this polynomial expansions with exponentials functions involved to make the curve way more smooth, and then make the entire borrowing experience more dynamic. Here's kind of a quick timeline for our products. On the top is our deployment time frame. We are targeting for the second batch for the Kusama auctions, which might take a little bit more time. And then we finish our first audit, and then we have another audit pretty soon. Eventually, at the end of the year, we'll do a Polkadot launch as well. So in terms of our functionalities, we have our staking lending, I would say 80%, 90% ready, and going over this auditing process to make the platform extremely safe. And then we'll run for a month or two of public testing, and then we will launch our full mainnets on Kusama. And then September, October, and November, there are some new ideas we plan to implement later on. So here's how we think about the specific lending issues that we can solve. One of them is obviously this fixed term products. And then the second thing is something I just mentioned about, which is the new interest rate curve. And eventually there are some new ideas we can implement going vertical. And in terms of horizontal, we're thinking potentially to help with other staking derivative, but this is not even a short-term idea. So now let me switch gear to staking issues. So for the existing holders, DOT and Kusama holders, it was a little bit complex for users to stake themselves through Polkadot.js accounts. They require a little bit of domain knowledge about how the staking works. And currently, there's no good solutions to protect against the slash loss. And then lastly, there is no liquidity and low capital efficiency. So what we do on the other side is we make the parallel staking solutions with 4 different features. The first one is that we design this automated validator selection algorithms to make sure that make the entire process smooth and easy for user, but at the same time trying to maximize the yield. Second of all, we have this insurance pool. And then third of all, we have this leverage staking operations, which I will show you guys later on. And lastly, staking derivative can be used as a collateral to increase the capital efficiency. So here's if you see this dilemma between staking and lending. On a traditional markets, users have to either give up on the network security to participate in DeFi yield, or give up on the lending liquidity to go back to staking. But I think that the better solution here is to compose staking and insurance on the bottom to support lending on top of it. The more specific example here is that what user can do in the system is they can potentially leverage on top of the staking operations with the borrowed assets, as long as the borrow interest rate is lower. So if you see the graph here, when the borrow rate is lower than the staking rates, there is an arbitrage opportunity for people to borrow additional Kusama to restake, which have this effect, whereas more and more people borrow, and then we push this interest rate equilibrium to be similar or equals to the staking rates, which is actually good because it increases the utilization ratio of the whole Kusama pool. And then talking about the score, we have this idea of automate this process. So first of all, we will have a reputation for the existing validators, 0 or 1. As long as you have a slash, you'll be 0. So the token holders, our governance token holders, can decide on the whitelisted validator sets, and based on that, we will choose every epoch with 16 validators based on their commission rate, based on the nomination amount, and things like that, right? Say, for example, the lower commission rate is better, right? That's why we do 1 minus commission rate. And then the nomination amount is lower is better. That's why we divide it by the nomination amounts. Check out our white paper to see more details. And then this is the basic staking workflow. And then the way that we calculate exchange rate is generally similar to a equity model, whereas the X token essentially represent the pro rata shares of the staking pool, right? Say that we have 1,000 staking pool in total, and then you have 1% of the X Kusama tokens, meaning that you are entitled to have 10 Kusama in this pool, which is 1%. And then here's a quick summary. So we have staking lending on the top, and then we are developing auction loan products. Hold tight, we will have more information released very soon. And then we're trying to support the best with Polkadot ecosystem and Kusama ecosystem. So that's the presentation. Thank you so much. Please visit our website and follow us on Twitter and then obviously Discord to have more information. Thank you.
Hey, Yubo. Hey, we have a few. Do you have a few minutes to kind of go over like a quick Q&A of a few questions from the community?
Yeah, let's do that.
Okay, perfect. Yeah. So I have one from Esther. She says, "Is this safe? What happens if KSM goes down? Will I get liquidated?"
So for money markets, yes, there will be a liquidation engine if you borrow, let's say USDT, and then the Kusama value going down. As long as the health factor above 1, you're safe. If the collateral value go below the loans value, then you will have to be liquidated. But on the other side, we have staking derivative called xKusama. We actually don't have a liquidation engine for that. The reason for this is because we have an insurance pool to insure against any potential slash, meaning that the xKusama exchange rate, if you see from a function against Kusama, it will be a step function. It can only go up whenever there's a reverse. If there's a slash, we will cover from our staking pool.
Okay, so like is the KSM and then stake KS, is it a stake KSM? Is it the 1-to-1 ratio, and then after a while it starts increasing over time to kind of like represent the portion that's insured? So like it's like a bonding curve that allows you to have like the earlier ones, the earlier accessor ones are able to get like a bigger amount of staked Kusama, xKusama.
Yes, so if you participate earlier, right, then you are earning this staking operation rewards as early as well. And then so we have a staking pool that is operated by our parachain. Whenever there's staking rewards happening, then your exchange rate will go up to represent this appreciation of the staking pool. And then usually for other solutions, you see the staking rewards, this validator can get slashed. If that happens, then users lose their part of their staking rewards, which in turn meaning that their staking exchange ratio went down. But for us, because we have an insurance model, we will cover every time whenever there's a slash. So make sure that it's a step up function, monotonic, curve, up curve for the user.
And like slashing, it doesn't occur often, right? It occurs like potentially never, or how does slashing work? Like what happens if someone gets slashed?
Yeah, exactly. So Polkadot has this slashing mechanism. It depends on the levels of issues. The level 1 is this unintended irresponsiveness, right? If your server go offline for a period of time, then you might get slashed for very minimum amount, 1%, say. And then there's level 2, and then there are some misbehaviors, but it's not influence the network security. You might get slashed for a few percent. And then for the last level, which is level 3, if the validators we nominate for did something seriously influence the network security, the validator might lose all of them, potentially, or at least a portion of that. It didn't happen before. I think this is a small probability events, very small probability events. And since we're constantly selecting the validators that have very good history, remember we have the score. If you get slashed one time, you will be removed from the whitelisted staking validator sets for at least a month. So we want to make sure that good validators obtain in our sets. And yeah, based on the probability, we want to optimize the return and minimize the risk.
Gotcha. And like, these validators, it's like kind of like their business model to not get slashed, right? It's you're losing money if you're getting slashed. And then from that too, it's Esther had another question on here. It says also about the interest rate curve. I don't really get it. Can you kind of explain a little bit more about the interest rate curve for her?
Yeah, for sure. Money markets like Compound and Aave, they use a step piecewise function to determine the borrowing interest based on the utilization ratio. What does it mean? Like 50% utilization ratio, meaning that the pool, like 50% of the capital in Kusama pool has been borrowed out, meaning that it's 50%. And then the borrow interest rate is a function of that. So meaning that the more people borrow, the higher utilization ratio of the pool, and then the higher the interest rate will go over time. And then if you see the borrow curve for Compound and Aave, there's a kink point, whereas it changed dramatically for the slope. The reason they designed this way is because they want to maintain the optimal utilization ratio around 80%. So they want to make sure that 80% of the capital pool has been borrowed out, which is good. More people utilize the capital, but it's not 100%, because if 100% of the capital from the pool has been being borrowed out, meaning that there's no liquidity to return the capital to users. Mm-hmm. In fact, a lot of traditional banks, they maintain around 85% utilization ratio, meaning that they put 15% reserve value. And then for the case in Polkadot and Kusama space, we realized that we cannot directly copy from Compound and Aave curve. One reason is that is this instant change over the slope, which is very unhealthy for a lot of users. They can suddenly see a huge jump out of their interest rate, which is unfriendly for a lot of the Kusama borrowers. And second of all, we realized that there is a competition between lending and staking. So we want to make sure that our curve kink ratio is relatively close to the staking ratio, meaning that when we achieve this optimal utilization ratio, the lending rates is similar to staking rates, meaning that there is not much of arbitrage opportunity. This is the interest rate equilibrium. It's best. If you just copy directly from the Ethereum model, it will have a difference between them. When we achieve the optimal utilization ratio, the interest rate can be much lower than staking rates, meaning that no one want to lend. If it's much higher than the staking rates, meaning that a lot of people still want to sacrifice lending to go to sacrifice network security to go back to the lending pool. Either case is worse for the ecosystem. So we want to make sure that equilibrium reaches at that kink point.
Yeah, because with fund utilization, it's as well as how the banks do it too. Yeah, they usually keep 15% in reserve, lend out a portion of it, and then that's how they're able to achieve their interest off of it. With I like the other fact that you mentioned as well, the staking rates too. So if you see something that's staking at 18% and you see lending at 14%, why would I lend? I'd rather just stake, right? Exactly. And then if it's more lucrative, then yes, I want to make sure that I stake. Now you said you guys keep around a 20% reserve for your staking, for your fund utilization.
Yeah, we're thinking about 20% ish. It depends on the distribution of the users. If a lot of them are large holders, I think that's the case. So we have to minimize the utilization ratio a little bit. As long as the DOT holder, Kusama holders, be more decentralized, more holders, then we wanted to increase the utilization ratio a little bit.
And then this is going to be across both chains, right? So you're going to be consistently running on Kusama and Polkadot as two separate ecosystems. Now, will you guys be bridging the liquidity over, finding let's say, for example, utilizing both chains liquidity, or just one chain by itself in like a vertical?
Yes, we have both parallel parachain on Polkadot and Heiko parachain on Kusama. It will be two separate chains. And then once the bridge between Kusama and Polkadot has been ready, then we wanted to bridge liquidity into one single web app, so people can use one single interface to have this DeFi experience or lending experience for both platform.
Yeah, because like if you bridge liquidity too early, you know, like both chains, it might still produce a lot of arbitrages to be like, why don't I just stake on Polkadot, or why don't I just stake on KSM?
Exactly.
I have another question from Action Crypto. It says, what prompted you to to start this?
Yeah, I wanted to solve problems. I see. So first of all, I am a dot holder, Kusama holder myself, and I see these issues for a long period of time. I don't want to solve it. And second of all, I truly believe this Polkadot technology, and it really provides this highly scalable blockchain that is customizable. We can connect to the off-chain real-world informations, and also we can customize the consensus layer, P2P layers, and everything. I think it's super interesting topological structures to build future Web3 related applications, and as well as DeFi applications. We choose DeFi is because this is a very large problems where demand at this specific moments. In the long term, I can see other problems that we wanted to solve. I am an investor myself as well. I run a fund called A Decimal Capital, invested over 40 projects. My motivation here is not to make money, but instead to contribute back to this whole blockchain space. I don't see us like competing with other parachains. I see us really trying to bring this traditional, I guess this decentralized finance revolution to the real world. The real economy has over 100 trillion assets, and we're less than 1%, 5% of that. So we're competing with, right? We wanted to bring them into this new world, and once they're into the new world, they'll actually have good user experience and good benefits to them. And I see that as a very meaningful and meaningful actions to pursue.
Yeah, and I like how earlier you mentioned about the fund utilization for banks as well. Like a lot of users don't understand like how that actually works. So just to like a brief reminder for everyone, like the reason that decentralized finance is really taking off and people are seeing different yields is because of the fact that, let's say for example, if your bank utilizes just a 10% utilization ratio, what happens is if you're able to deposit into the bank, let's say $100, they're able to take out $90 of that and then lend it out for additional interest. Now, if you look at it on a massive scale, so let's say if you have 5 million users like Chase, Wells Fargo, or kind of like some of these big banks, you're able to lend all that out together. But then that's just the lending side of it. That doesn't include the margin side. So with margin, you're able to I believe it's up to 10x that on certain positions for banks. So they're making 40, 50, 60, 70% interest on some of these loans, and the user just gets what 0.02 or even like 2%. It's like a high interest yield. So that's the thing about decentralized finance, and a lot of these companies are building because like people don't understand like the fund utilization side, the lending side, the borrowing side, and also for that too, it's like later on we're able to have more capital efficiency once blockchains are able to integrate together and start producing a shared liquidity across a lot of the pools as well.
Exactly. I also wanted to see more competition. So a lot of people say, hey, there are other parachains with lending protocol. And I told them that, hey, monopoly is very good for it's very good for the company, but it's very, very bad for users, right? And there's no way that monopolies would, provide the best, always provide the best returns. If you see like many projects, that's the issues they face. So for us, we actually wanted to see multiple competition in the space so that we can bring the best yield to the user in the end, and that really what it matters, right? So if we have the best user experience and best yield for the actual platform stakers and users, then we can truly provide values to them for the long term, instead of like grabbing some values from the other chain, right? If that is our goal, then I don't see this is super meaningful.
Well, I think it's just like bridging for fund utilization and then like liquidity, but not like as in like stealing and stuff like that. We're not going to steal liquidity unless our product is going to be better. Exactly. And I feel like also for that too, it's like it has to be a little bit of like healthy competition within the markets, right? If you only had Compound with no Aave, it's kind of like everyone's on one protocol. So what happens to the yields? Everyone's just going into one. The actual, the percentages go down, but having multiple platforms lets users go back and forth and say, hey, look, maybe this one's going to be better for my long term. Maybe this one's going to be better for the short term. It gives them speculation, and it gives them a lot more things to do as well.
Right, 100%.
We have one last final question from Launchpool. Would you see your project doing well in the bear market?
Yeah, it's very interesting because in the bear markets, people's sentiments generally become negative to the tokens, right? They have a huge demand to sell. So for us, actually, lending protocol is perfect in this solution. First of all, for the long-term holders, they need liquidity without selling them. So lending protocol is the best solution. So they can lend and then they can borrow cash. For the users who has a bearish view on the markets, what they can do is they can actually do the opposite. They can supply stable coins, and then they can borrow DOT and Kusama, sell off at a higher price and then buy back lower and pay back the loan. They can be profitable doing so. So I see lending protocol being healthy during the bear market. It just the demand for, I guess, the interest rate will switch. So during the bull markets, interest rate will be higher for stable coins because of this demand for additional investment and leverage up. And then during the bear markets, then the demand, the interest rate for DOT and Kusama tokens will go higher because more people are trying to borrow them, potentially to hedge their risk. And that being said, for us, I don't see that as a pretty cyclical product, but I think it's against the cycle.
Excellent. And yeah, kind of like another thing about lending protocols too is that a lot of users haven't seen kind of like, well, some of them have seen like the Oracle risk as well. Sorry, this is not a question from them, but from me, in terms of like the Oracle risk. So we kind of like seen with like Compound, how they utilize Coinbase's API Oracle mixed with a little bit of Uniswap Oracle. Are you guys doing a different method for the Oracle services, or how does that happen on chain?
Yeah, that's a really good question. So we are actually using a lot of different ways to solve these problems. So for our markets, we are having two essential markets. So the first market is the markets where we have the staking derivative trading against the native token. For this part, we designed this a little bit special way to do liquidation. As I mentioned, we actually don't do liquidation when the staking derivative drop because of the insurance mechanism. And then for the normal currencies, right, DOT versus USDT, we use multiple sources of prices from Coinbase, from Binance, from other exchanges, and then as well as from our own AMM pools in the future. Because whenever there is a liquidation opportunity, some users have the demand to swap their purchase and back to the cash. So it makes sense for us to provide a quick instant step when the the cross-chain mechanism is not fully ready at this moment. And then eventually we run this Oracle clients that everyone can run, and then people have incentive to run the server on our parachain, and then we have a price aggregation on chain. Get rid of the outlier prices, the top outliers and the lower price, and then find the median price, and then use that as a more relevant method to accumulate every single block.
Gotcha. So you guys use more of like a little bit more of like a weighted model compared to just like a single source or a dual source type of Oracle service.
Yeah, exactly. And the other detail here is that the way that we liquidate our position is a little bit different. So on Compound, they liquidate 50% whenever the health ratio drop below 1. So it is good in the sense that you can essentially draw back the health factor very fast to higher ratio, like maybe 2. But you have to get liquidated by 50%, even if you're just $1 shortfall, right? Even if you just like have $1 loss against your collateral. So what we do is actually we make it a little bit more dynamic. Whenever there is a difference between your collateral value to where your outstanding loans, then we try to bring back the health factor to a targeted value, maybe 1.05. And then so it doesn't have to be 50%. It can be 30%. It could be 70%. But we just want to make sure that during the discrete time, right? So when the price drop, it doesn't drop like instantly per every second. If you see like the big crash in March 13th, March 12th, if you see every single seconds, it doesn't drop like that much. It's only a few percent or a few basis point drop. So we want to make this method more smooth to make sure that users don't get slashed too much or get liquidated too much.
Yeah, because we saw a lot of people get liquidated on Maker due to we call it Black Friday or Black Thursday or something. And then a lot of it was, the network fees went up really, really high, and a lot of people are just trying to exit positions or, recapitalize to place back their loans, to repay back their loans to get to higher level. Do you have time for one more question? I'm sorry, the audience is asking a few.
Definitely.
Yeah. So this one from Iqbal is like, what are the backgrounds of the team?
So I am the founder and CEO. As I said, I'm an investor before at Decimal Capital. I'm also running it, but only 5% of my energy. Before that, I am an entrepreneur. I started my first company I guess during high school. We started this robotic company to provide a financial tools for children, right? So it's a physical product and people can put money into it. It's a piggy bank. It has a phone application on top. So parents assign tasks, chores, homeworks to children. And if you do well, then there are some rewards as of a virtual money to the users. So we ran the company for 2 years. After the company was acquired, I went out into working at a few venture fund, eventually started my fund. That's kind of my story. And then our team, mainly from, so we have a team of 12 people. Most of them are engineers from different blockchain companies. We have people from, like Parity, from Elasto. We have people from Facebook, and then they all have pretty good, both like traditional web application experience and DeFi experience or like blockchain experience. So, and we have an advisor from Stanford University as well. And then they're helping us with some protocol mechanism design and economics. Yeah.
Excellent. Yeah, we got a comment. It's like, dude, you look so young. Amazing what you've done and accomplished in such a short time frame. Yeah, from David.
Thank you, David.
But yeah, thank you, Yubo, for going on to demo day today and kind of like presenting, parallel finance to the community. A lot of us are really excited for parachains happening, especially like Kusama parachain just started. Hopefully Polkadot comes along with it as well.
Mm-hmm. Absolutely. Thank you, guys.
Thanks, Yubo.
Join Discord and then we will chat.
Thanks, Yubo.